Hey there. Sorry we're a little late this week.
Better late than never.
Right. We had some technical difficulties here at Debt-Free Guys Live.
Comedy of errors with Murphy's Laws
Right.
all intercating at one time.
Exactly. So we're kicking off this week with a great discussion all around your credit score.
Yep. So welcome to another Debt-Free Guys Live. This is just one of the many platforms that David and I, the Debt-Free Guys, try to help the queer community live fabulously, not fabulously broke.
Absolutely.
We believe in building a strong queer community. We believe that our community needs to be stronger, and that one of the pillars of a strong queer community is financially strong individuals and allies, and that's
Right.
where we come into play. So all of our content, everything that we do is to try to help build that strong queer community. So we want to thank you for joining us and for joining our strong queer community.
Absolutely.
This week, as David said, we're talking about improving credit scores and improving your credit or fixing your credit report.
Right.
On Monday, we published an article of 7 tips on how to improve your credit score. On Tuesday, our Queer Money podcast featured Colin Brennan from Credit Karma, and he gave us all sorts of ins and outs and the secret sauces of fixing your credit report, improving your credit score, and had some great tools that Credit Karma provides that are free to you, to everybody, to help improve and manage your credit report and credit score. So today we want to talk about what makes up a credit score, so that you can figure out what are the most efficient actions for you to take to start to improve your credit score. We've received lots of emails, direct messages, lots of you reach out to us in different fashion, and it seems that our community has 3 concerns. The first is most of us want to pay off debt, which just so happens we're the debt-free guys, so yay, we can help you out with that.
Yeah.
2, many of us are concerned about retirement, but our third concern is fixing or repairing our credit scores and our credit reports. So
Right.
that's why we decided to create this content today.
So just want to remind you that we are doing a whole series on helping you get out of debt, and if you are trying to get on that process of trying to get out of debt, search the hashtag Debt-Free Guys Live, where you're going to see the posts that we've been doing. All of these Debt-Free Guys Live posts on Facebook that are walking you through this get out of debt process. And as John mentioned, tonight we're going to talk about the 5 things that make up a credit score. And this is vital for you getting out of debt. And the reason for that is because most of us, the reason why we have so much debt or have had so much debt is because we had such low credit scores and our interest rates are really high on our credit cards or our loans, and we're not able to get ahead of the curve when it comes to paying those off. So just as a reminder, click the link above to get the credit scores checklist that we're going to be talking about all during this post or this Facebook Live today.
Exactly. And if you could help us reach more LGBT people, please like, comment, and share below, as well as if you have any questions about this or any content that we've created or anything about finance, please comment below and we'll answer all those questions at the end.
Yeah.
So
just say hi to those who have joined us. Thanks, Kathleen and Will, for joining us.
Yay. Yep, absolutely. Thank you for joining. So to kick off, the first 2 are the components of a credit score are the big components. These are the ones that have the heaviest weight on what your credit score is. And we call this particular section size
When
matters.
size matters. Because size does matter sometimes, right?
Exactly.
Especially when it comes to your credit score.
Right. So the first of those 2 components within the 5 components of a credit score is payment history.
Right.
That actually is weighted by 35%. According to FICO, which is the organization that calculates credit scores and provides that information to TransUnion, Experian, and Equifax.
Right.
So your payment history, your delinquencies, especially those that are older than 30 days, any sort of collections or anything on public records, such as bankruptcies, foreclosures, wage garnishments, liens, those all weigh into your payment history.
Right.
Basically, what FICO is saying is that your past performance does in fact predict your future performance. Unlike the stock market, where they often tell you that past performance does not predict future performance,
Right.
FICO and your credit history actually say otherwise.
Right. So basically what they're saying is this one major factor, this is 35%, more than a third of what they figure your credit score to be is based on your payment history. How often, how regular you're making those payments.
Right, exactly. So what they're looking at here is they're looking at the frequency of negative marks on your payment history.
Right.
They're looking at the recency or the most recent activity, negative mark that you've had on your payment history. And they also look for the severity of the negative marks. So if you're delinquent on a $10 loan, it's not as egregious as if you're delinquent on a $10,000 loan. So they weigh all that into account, and that makes up 35% of your total credit scores. So the lesson there is to pay your bills in full and on time. And if you're currently behind on any bills, you have any delinquencies, or you're sort of in the process of wage garnishment, try to rectify those as quickly as possible. The sooner that you do, the faster you will improve your credit score.
Right. And one of the ways to do that is to make sure that you automate your bill payment. We had a post on Debt Free Guys talking about automating your bill payments or automating your budget. Go ahead and search Debt Free Guys automate your budget, and you'll find information on that.
Exactly. So the second component that where size matters with regard to your credit score is your credit utilization. And you'll see that is the blue section there at the bottom. That makes up 30% of your credit score. So payment history makes up 35%, credit utilization makes up 30%. So right there, those two components alone make up over 2/3 of what calculates your credit score.
Exactly. And that's why we say in this particular section, size matters. More than 2/3 of what your credit score is made up of is focused on those two things. It's focused on your payment history and on your credit utilization. So what's credit utilization?
That's just a big fancy word for how much credit you have available relative to how much you're currently using.
Right.
So the more credit you have available, the more credit you're using of what you have available, the higher your credit utilization. So experts kind of range between try not to use more than 30% to try not using more than 50% of your credit utilization.
Right.
So there's a tricky tip here, not necessarily something that a financial planner would tell you, but I don't have my CFP license, so I'll tell you what I want. If you want to improve your credit, a tip that you can do to improve your credit utilization is to increase your available credit. And that'll automatically reduce your utilization because you're using less credit than what you would then have available by increasing your available credit. The problem with that, though, is that you're opening yourself up to more risks. So if you've proven to yourself that you're not good with using credit and debt, it may not make sense for you to increase your available credit.
Right. So I'm just going to go back to this whole idea of credit utilization because sometimes some numbers help. So credit utilization means how much of your credit that you're actually using. So let's say you have one credit card with a $5,000 available credit limit. If you're using 50% of that, you're using $2,500. Now, what do the best credit scorers, how much do they use, John?
So,
softball here.
Yeah, softball answer here. Some of the people with the best credit scores tend to not use more than 6% of their available credit.
Exactly.
So if professionals are telling you not to utilize more than 30 to 50%, and the best people are only using 6% or less, that should give you an indication of how much of your credit you should be using at any given time.
Right. So that means if you have a line of credit between your credit cards available of $10,000, if you're using 6%, you're only using $600. That seems like a lot of money that you're not using. But
credit, yeah.
It also, a credit that you're not using, but it also proves to the banks, it proves to those lenders that you have the ability to pay your credit off. And that's why you get a better credit score with such low utilization.
Exactly. So if you listen to nothing else that we've talked about this week, if you can improve these two categories, your payment history and your credit utilization, you will start to improve your credit score.
Absolutely.
But of course, listen to everything that we say and don't stop watching this Facebook Live.
Right. And remember, again, if you really want to put forth the effort to improve your credit score, there's some vital things that you need to do. And they are all talked about, they're all in a checklist for you if you click on the link above to get our credit score checklist. Use that checklist, to help improve your credit score. These are all steps that we used when we were getting out of debt and tried to improve our credit score so that we could get the lowest interest rates when we were refinancing our debt.
Exactly. So there's over 30 different recommendations that we have included on that checklist. Follow each one of those and you'll start to slowly see your credit score improve. It does take time to improve your credit score. There's no quick fix to this, unfortunately.
Right. Unfortunately.
But if you follow those steps that we've outlined in that checklist, you will certainly improve your credit score and you'll reach your goal. So the next section, section 2, we call from good to great. So everybody wants to have a great credit score. Credit scores range from 300 being the lowest, which you have to really, really try to get that low, to 850, which is you have to be absolutely spotlessly perfect to achieve that credit score.
Right.
That's pretty high.
Yeah, actually, we talked about this a little bit with the guy from NerdWallet on our podcast this week, and how some of those people, Credit Karma, some of those people at Credit Karma are really trying hard to reach that 850. They become such nerds about making sure their credit is spotless, and we suggest that you try to reach the highest you can, but focus on what's important, and that is getting your debt under control.
Exactly. So the first of those 3 components from the good to great, these are the ones that help you get from being good to being great. The first is the length of your credit history. This makes up, as you'll see there on the slide in yellow, 15% of your credit score. So it's not nearly as weighted as heavily as the previous 2 that we talked about, but it does have a significant weighting. And basically what this is it's how long you've had a credit history.
Right.
So very often we receive emails or direct messages from people who are just graduating high school or just graduating college, and they say, I don't have a credit history, so how do I go ahead and get started with one? Well, this is that's the problem that they're trying to solve. They don't have a credit history, so that's that 15% component. The first thing that you can do is to put a bill in your name, and we oftentimes recommend a cable bill or a phone bill, or if you can put your car insurance in your name and then start to make payments on that, that's a great way to slowly start to build a credit history. Another option is to get a credit card and to use it judiciously, not to acquire too much credit, but use your credit card, make sure you pay it off each month, and over time you'll start to build a history.
Right.
And of course, the longer that your history is, the more advantageous it is for you, only if your credit history is good.
Right.
If you've shown yourself to not be good with credit over 10, 15, 20 years, you're going to have an abysmal credit score. But if you've shown yourself to be good with your credit over 10 to 15 years, you're going to be more likely to be able to achieve that 850 credit score that is almost impossible to achieve.
Right. So the word of caution here, a lot of times people think that one of the best ways to improve their credit score is to close their credit card accounts or close the accounts that they have their credit history on. Well, unfortunately, if you close the ones that you have the longest history on, even though you may have some negative marks, if you close the ones that you have the longest history on, you can actually decrease your credit score because they're looking at that length of credit history. Mm-hmm. So we encourage you to keep the longest credit card that you have the history on, or the longest account that you have loan history on, keep that open, and then close those ones that you have less history on. Even though you may still have some negative marks against you on that long one, keep that long one open because it is such a large factor here. 15% of your credit score is factored on that length of credit history.
Exactly. And we'll admit that this is where we differ with some of our colleagues. Many of them say keep all of your credit cards open, just start only using a few or one of those. We don't agree with that because if you keep your credit card with the longest history, you've maintained your history essentially.
Right.
And if you're able to close those other credit cards, that decreases your chance of overextending yourself. And also, if you've got too much available credit to you relative to your income, that can hurt you as well.
Exactly.
And we want to make sure that we're addressing everything that can affect you and not just one particular component.
Right.
So the number 2 in this particular category, 4 overall, is the type of credit that you used. This makes up 10%, as you'll see there on the pie chart. This makes up 10% of your credit score. And so what does that mean, the type of credit that you used? Well, there's revolving credit, which is typically most commonly known as credit cards.
Right.
Then there's installment credit, which is typically or most commonly known as mortgage payments, car loans, even student loans. So what FICO is looking at there is they want to see sort of a healthy balance, that you're able to adequately or maturely use both types of credit, make payments in full and on time on both types of credit. And that has a 10% effect on your credit score. So if one way that you might want to improve your credit score is if you're not using one type, to add that to your mix if you are only using one particular type.
Right.
It only has a 10% weighting, so I don't know if it's really worth taking on more debt just to utilize a different type.
Right. One of the things here that's interesting about this type of credit is those longer-term credits. So, for example, taking out a loan from a bank, whether it's for an auto loan or a mortgage, those longer-term ones, what has basically happened is the bank or the lending institution has said that you are less of a risk, that they're going to give you that longer-term loan. Versus, say, for example, a credit card, they're going to give you a short-term loan because they expect you to pay that back regularly. Those longer-term ones basically say you're a little bit better credit risk, and that's why that can improve your credit score if you're using some of those other types of credit.
Exactly. And last but not least, because it's equivalent to the last one, is new credit inquiries on your credit score. So what does that mean? Every time that you go and seek to take out a new loan, apply for a new credit card, get a new mortgage, take out a new student loan, your credit history is pulled because that particular institution wants to investigate you to decide whether or not you're worthy of taking on the risk. Well, if there are too many of those inquiries at any one time, that's a red flag to FICO that, okay, Jane Doe is doing something,
right.
And we need to be prepared.
Somebody's out shopping and doing all sorts of credit card applications at the mall.
Right.
Big risk to your credit score.
Not ironically, we do typically see an increase in credit inquiries starting on Black Friday because every store you go to, they say, do you want to open a credit card? It can give you a 10% discount. It can give you a 15% discount. And then a bunch of people say, yes, please do that because they want the discount.
Right.
And all of a sudden, they've amassed 2 or 3 different credit cards. And yes, you're getting a discount on that particular purchase, but they're also getting a hard pull on their credit history, and that will decrease your credit score. And I just said, a dangerous word.
What is a hard pull?
What is a hard pull? So a hard pull, there's a hard pull and a soft pull on your credit history. A hard pull is when somebody's doing some serious research on your credit history, and that typically happens when you're getting a mortgage or taking out a student loan, especially if you're applying for a credit card.
Yep.
There are instances where they do a soft pull, and such an inquiry is like if you've noticed recently that you go to your credit card account or you go to your bank account. David and I have a credit union every time we go there, or even Credit Karma. They are all able to provide you your credit score or indication of what your credit score is. Well, every time you do that, it actually doesn't count against you as a credit pull because it's considered a soft pull, not a hard pull like a mortgage company would do.
Right.
So soft pull's good, hard pull's bad.
One of the few times where hard is not good.
Always. And so those are the 5 components that make up your credit score. And as you notice, if you look at the final pie chart, the first 2 that we talked about, payment history and credit utilization, have the biggest effect on your credit score. So if you're going to address anything and you need to improve your credit score quickly, we would recommend focusing on those 2 components first. The other 3 components, while yes, important, they're not as effective. So maybe work on those, but not as egregiously aggressively as you would the prior 2.
Right. Yeah. So remember that 65%, almost 2/3 of what goes into factoring your credit score are those 2 things, and that's why John and I encourage you to focus on those: your credit payment history. So making sure that you're making those payments on time, and then
your credit utilization.
Your credit utilization. So get your balances down or increase your credit limit if you have the ability to increase your credit limit.
Absolutely. And shout out to Joe Pacheco and Steve Higgins-Prell for joining us. We'd love seeing you.
Yeah.
And that makes up today's Facebook Debt Free Guys Live. We've renamed it. We're more important than Facebook, right? So we want to thank you for joining us. If you have any questions now, please ask us at the comments below, or after you watch this in the future, please comment below and we'll try to respond to those questions. Please don't forget to join us next week for another Debt Free Guys Live, when we're going to talk about our favorite money hacks, some of which you've never even heard before. So don't miss that. We're going to start talking about that on Monday. We will have a Debt Free Guys Live on Wednesdays, 7 p.m. Mountain Time, 9 p.m. Eastern. Again, don't forget to click the link above to get the free credit score checklist. And then after you review that checklist and you implement some of what we recommend there, please go to the private Queer Money Facebook group and let us know how it worked out for you. If they worked out great for you, we want to be able to celebrate with you. If they didn't work out with you, we want to know what we can do to improve that checklist so it helps other people better. Our goal is to serve you, and we don't know if we're serving you properly if we don't get any feedback from you. So please let us know how those work out for you, and join that private Queer Money Facebook group where we're helping thousands of people live fabulous lives without being fabulously broke.
Exactly.
And if you want to see any other Facebook or Debt Free Guys Live in this series, please remember to search hashtag DFG Live, and you'll be able to pull up all of what we're doing with this particular series and start living fabulously, not fabulously broke. Thank you very much, and have a happy Thanksgiving. Please be safe. Don't eat too much turkey, but drink enough wine.
Yes, exactly. Have a good weekend. Bye.